Mexico just pulled a move that could send shockwaves through the U.S. economy, one so calculated that even Canada was caught off guard. We're talking about a high-stakes trade maneuver that could cripple American manufacturing, squeeze energy supplies, and throw Washington into a full-blown crisis. So what exactly is happening? Why is Mexico suddenly flexing its economic muscle in a way that could change the balance of power in North America? And most importantly, how will this hit your wallet? Stick around, because by the time we're done, you'll see why this is bigger than just trade. It's about power, survival, and political warfare. Mexico's oil exports to the U.S. have collapsed by nearly 50% since 2018, and the consequences are hitting American refineries hard. According to Bloomberg, Mexico supplied just 349,000 barrels per day to the U.S. in January 2024, down from 648,000 barrels per day in 2020. Claudia Sheinbaum's administration is doubling down on energy nationalism, ramping up Mexico's refining capacity at the new $15.6 billion Dos Bocas refinery, aiming to process oil domestically instead of exporting it north. Pemex CEO Octavio Romero confirmed that Mexico's goal is to eliminate crude exports entirely by 2025, forcing U.S. refiners to scramble for alternative heavy crude supplies. The shortfall is already pushing U.S. gasoline prices higher, with AEA reporting a 16-cent per gallon increase in just the past month. The ripple effect extends beyond fuel costs. Valero and Phillips 66, two of the largest U.S. refiners reliant on Mexican crude, saw stock dips of 4.2% and 3.7% respectively after Mexico announced further export cuts. Refinery disruptions are inevitable, especially in Louisiana and Texas, where plants are optimized for heavy crude blending. Analysts from Rystad Energy warn that without Mexican crude, U.S. refiners may need to increase reliance on Venezuelan and Canadian oil, which carries higher geopolitical risks and costs. The timing couldn't be worse. OPEC Plus just slashed production. Global oil prices are nearing $90 per barrel, and the Biden administration has little room left to tap into the Strategic Petroleum Reserve, which is already at a 40-year low. Mexico is the backbone of the U.S. auto industry, exporting over $100 billion worth of vehicles and parts annually to American automakers, per U.S. Census Bureau data. But now, the supply chain is at risk. New Mexican labor laws, backed by Sheinbaum's administration are forcing automakers to increase wages by nearly 20%, escalating production costs for GM, Ford, and Stellantis. In response, Tesla delayed its planned $5 billion gigafactory investment in Nuevo Leon, signaling uncertainty over future expansion in Mexico. A report from Bloomberg Intelligence states that even a 10% disruption in Mexico's auto exports could push U.S. car prices up by at least $1,300 per vehicle, given how deeply integrated supply chains are. General Motors CFO Paul Jacobson warned investors in February that continued instability in Mexican trade policy could wipe out $3.5 billion in projected profits for 2025 alone. Meanwhile, Mexico is courting Chinese EV manufacturers like BYD, which recently announced plans to invest $600 million in new Mexican factories, bypassing U.S. tariffs while undercutting American automakers on price. If Mexico begins favoring China's auto industry over the U.S., it could permanently reshape North America's vehicle market. Mexico's potential tariff hikes and export restrictions could hit Trump's key Rust Belt states the hardest, including Michigan, Ohio, and Pennsylvania, which are home to over 400,000 auto manufacturing jobs tied to Mexican supply chains. If Mexico retaliates against U.S. trade barriers, it could lead to severe disruptions in steel, aluminum, and auto parts, impacting Trump's blue-collar voter base. In 2023, Mexico surpassed China as America's #1 trading partner with $700 million, $8 billion in total trade per the U.S. Census Bureau. If Mexico selectively limits exports to certain states, it could strategically weaken Trump's campaign narrative on bringing back American jobs. A report from Oxford Economics predicts that a 5% reduction in Mexico-US trade could eliminate 150,000 American manufacturing jobs, disproportionately hitting swing states. Washington is bracing for impact. Trump's energy strategy hinges on increased domestic oil production and refining capacity, but Mexico's withdrawal from the U.S. crude market threatens that foundation. According to the Wall Street Journal, U.S. oil imports from Mexico have plummeted by over 41% in 4 years, forcing refiners to seek higher-cost alternatives from Saudi Arabia and Venezuela. With the strategic petroleum reserve depleted to just 370 million barrels, the lowest level since 1984, the U.S. is entering an energy crisis just as global oil prices are surging past $90 per barrel. Rapidan Energy Group predicts that if Mexico cuts U.S. exports completely, it could push domestic gasoline prices past $4.50 per gallon nationwide. This would directly undermine Trump's key 2024 campaign message of achieving U.S. energy independence. Washington is already weighing tariffs on Mexican aluminum, steel, and auto exports, which could trigger a tit-for-tat retaliation. According to a J.P. Morgan economic impact model, a U.S.-Mexico trade war could slash North America's GDP by $240 billion annually, with Mexico's economy contracting by 3.1% and U.S. consumer prices rising 5 to 8% on affected goods. If Trump escalates, Mexico has the nuclear option, cutting off U.S. agricultural imports, which total $28 billion annually. This would devastate American soybean and corn farmers, who rely on Mexico as a top buyer. A full trade war could obliterate over 1 million North American jobs, warns Harvard economist Danny Roderick. As U.S.-Mexico tensions rise, China is expanding its economic footprint in Mexico at an unprecedented pace. According to Reuters, Chinese firms have invested $6.6 billion in Mexican factories since 2021, particularly in the auto and electronics sectors, allowing them to bypass U.S. tariffs through the USMCA free trade agreement loopholes. BYD, Chery, and Great Wall Motors are already establishing operations in Mexico, aiming to flood the U.S. market with EVs at a fraction of Tesla and GM's costs. The U.S.-Mexico split is opening the door for Beijing to exploit trade gaps, shifting North America's economic balance in favor of Chinese manufacturing. While Washington scrambles to react, Mexico is playing the long game. By gradually phasing out crude exports, imposing stricter labor laws, and strengthening ties with China, Mexico isn't engaging in an outright economic war. It's choking U.S. industries slowly. This strategy avoids immediate retaliation while inflicting cumulative damage on U.S. energy, manufacturing, and trade policies. By 2026, if trends continue, Mexico's economic leverage over the U.S. will be stronger than ever, warns Goldman Sachs Latin America strategist Alberto Ramos. Will the U.S. counter-strategy come in time, or is Mexico already too far ahead in this geopolitical chess game? Trump's push for tariffs and aggressive trade policies against Mexico was meant to boost American manufacturing, but new data suggests it may be having the opposite effect. According to the U.S. Bureau of Economic Analysis, U.S. manufacturers reliant on Mexican supply chains faced a 12% increase in production costs in Q1 2024, largely due to retaliatory tariffs and disrupted imports. Ford, GM, and Stellantis have already reported a combined $4.2 billion in additional supply chain expenses this year, forcing them to pass costs on to consumers. The average price of a new vehicle in the U.S. now sits at $48,759, up 6.8% year over year, according to Cox Automotive. Meanwhile, U.S. agricultural exports to Mexico worth $28 billion annually are at risk. The Mexican government has hinted at further restrictions on American corn, beef, and dairy products, which would hit Midwestern farmers hard. Trump's 2018 trade war with China led to over $30 billion in federal bailouts for U.S. farmers, and experts warn that a similar scenario could unfold if Mexico retaliates further. Goldman Sachs analysts predict that if tariffs escalate, the U.S. GDP could shrink by 0.5% in 2024, with potential job losses exceeding 200,000 in manufacturing and agriculture alone. Gas prices are a political battlefield, and Mexico's recent shift in oil exports is adding fuel to the fire, literally. The U.S. Energy Information Administration, EIA, reports that Mexican crude oil shipments to the U.S. have dropped to 349,000 barrels per day, a 46% decline from 2020 levels. This shortfall has exacerbated supply pressures, with U.S. refiners scrambling for alternative sources, including Venezuela and Saudi Arabia, both of which demand higher premiums. According to Bloomberg, this supply squeeze has already pushed U.S. gasoline prices to a national average of $3.89 per gallon, with analysts at Rystad Energy warning that prices could exceed $4.50 if Mexican exports decline further. Mexico is already hitting back against U.S. trade aggression, and its next move could cripple American industries that depend on Mexican supply chains. According to the National Auto Dealers Association, 1 in every 6 vehicles sold in the U.S. is assembled in Mexico, and an estimated 800,000 American jobs rely on this cross-border production network. If Mexico retaliates by restricting exports of auto parts, electronics, and key industrial components, it could trigger a ripple effect across U.S. manufacturing. Experts at Oxford Economics warn that a 10% reduction in Mexican auto exports would raise U.S. car prices by at least $1,500 per vehicle, reducing consumer demand and potentially eliminating over 125,000 U.S. auto sector jobs. This would put blue-collar workers in key swing states like Michigan and Ohio at direct economic risk, creating a political firestorm. The U.S.-Mexico trade relationship isn't just experiencing a temporary disruption, it's undergoing a structural shift. For the first time, Mexico is asserting its economic independence, and the consequences could reshape North America's economic order for years to come. A study from J.P. Morgan projects that if trade tensions persist, Mexico's economy could grow by 3.5% annually, fueled by increasing foreign investment and domestic industrialization, while the U.S. could see a 0.6% GDP contraction due to rising import costs and supply chain disruptions. Mexico's rising wages, new infrastructure investments, and stronger trade partnerships with the European Union and China suggest it's building a future where it's less dependent on the U.S. and more aligned with global markets. For Washington, this means the era of unquestioned economic dominance over Mexico is ending. And if it doesn't adapt, it may find itself losing ground in its own backyard. The stakes are clear. Mexico is no longer playing defense, it's rewriting the rules. Trump's aggressive trade policies, once seen as a show of strength, are now facing unexpected resistance from Mexico's new leadership under Claudia Sheinbaum. Unlike past Mexican presidents who worked to de-escalate U.S. trade tensions, Sheinbaum appears willing to hold the line against Washington, prioritizing domestic economic independence over American political pressure. Trump, meanwhile, faces mounting economic consequences and electoral risks. If tariffs and trade wars continue to drive higher inflation and manufacturing slowdowns, it could cost him critical support in key battleground states. However, backing down would be seen as a political weakness, a scenario his campaign is desperate to avoid. So, the question remains, who will blink first? Will Trump escalate the economic standoff, betting that Mexico can't afford to retaliate? Or will Sheinbaum stand firm, forcing the U.S. to rethink its entire trade strategy? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.